Uh, Polymedicure, that's the stock in focus. They're looking to acquire Italian-based Medistream for around 324 crore rupees. Mr. Himanshu Baid, the managing director of Polymedicure, joins us on the show. Well, good to have you on the show, Mr. Baid. For the last many months, you were teasing us about acquisitions, and now you're making the step in those directions. So I'm going to come back to you. For the time being, just highlighting the three broad points that we want to focus on. The opportunity for them with this new acquisition, the impact of the GST rate rationalization, as well as what's the impact of tariffs, and finally, the outlook for their international business. Well, Mr. Baid, always good having you on the show. Tell us something about this newly acquired company. What's the scalability of this Italian company? I believe in the last year, it did around 17 million euros, with margins in that vicinity of around 17 to around 18%. Growth trajectory, and do you think the margins can come at par with what you're doing right now in the core business?
Good morning, Nigel. Thank you. I think, we have been working on a couple of acquisitions. So one we announced earlier in the month was Pendracare in cardiology space in Netherlands. And this is the second one, Medistream, which is a company based out of Switzerland, but manufacturing in Italy. And the most important thing with this company is they've got a long track record in the trauma and extremity space. And that market is close to around $16 to $18 billion. And majority of the market is in the US, actually almost 60%. And this company has got a FDA-approved product line. They already have a small base in the US. So this gives us an opportunity to expand into the US market with expanding their network. And also they have a direct sales force in US, Mexico, and Italy. So I think that also gives us some strength to deepen that manufacturing base there, and also leverage India in terms of cost reduction in different areas. And if you can leverage that, I think that will help us to grow this business. And I think the plan is to double in next 5 years.
Double the revenue in the next 5 years. All right. So it'll be approximately 35 million euros. With regard to that point on US, how big can the US market become for you in terms of revenues? Say as of now, what is it and where is it headed? Point number one. Point number two is you're sitting on a good amount of cash. Post this acquisition, what does the cash come down to? So on both those 2 points, US market and funding.
See, the US market, I think currently is around 3.5, 4 million. And I think the plan is to, almost take it to around 15 to 20 million by 2030. And, definitely we need to do some homework there and, increase our distribution network there. But that's the possibility from the current scenario. Though it's too early to predict, but that's what we think right now. On the cash front, I think we have used close to around 450 crores of cash in both the acquisitions. And we still have around close to 750 crores cash. Partially is going to be used for expansion in India. And that's going on, as part of the QIP proceeds. And I think balance will be used, as and when required.
Himanshu, hi, good morning. And good to see you build out various legs of this business, right? And it's such a big field, medical equipment and...
Yeah.
So good to see that. Just a quick point. I know I've asked you this before. I think exports to the US is very minuscule for you, value-wise, etc.
Yeah.
This company that you've acquired, does it have, you said they have distribution and sales force in the US. Do they have manufacturing in the US as well?
No, not manufacturing. Manufacturing is in Italy right now. But, now if you see our 3 European operations, all the 3 companies which are manufacturing in Europe have US FDA approvals. So that gives us this kind of a entry into the US market, with 3 companies. And of course, with India operations also focusing on the US. So I think we want to build up a substantial business in the US in next coming 4 or 5 years.
Okay. Now, this may be transient and who knows, right? I mean, the world is in a bit of a flux, but a bit about revenues doubling in the next 5 years for this company. How much of that is contingent on US sales? Because just as we speak, I mean, I saw this a couple of hours ago, that US is considering tariffs on import of medical equipment from outside. As I began by prefacing my question, who knows? And how long this will stay, whether this will happen or not. But any thoughts?
So I think US already has tariffs on Indian products and Chinese and a lot of other countries. So medical devices are not exempted and equipments are not exempted as of now. So like pharma, we are not exempted. So we still pay tariffs, but our products are going in the US. So, but being in Europe, I think that gives us a faster entry into the into the US market. And US market, let's say you asked about what could be the US market share. It could be around 40 to 50% going forward in the next 5 years.
Okay, all right. Final question then with regard to the GST, GST 2.0. It's been rationalized. How do you read it for your business? And also just revise the guidance for the company on the whole, domestic and international market as well. Quarter one was a little bit softish, so I ask you.
So I think on the GST front, I think it's a great move by the government of India. I think that reduces the cost for the patients overall. From 18%, 12%, we have dropped to 5%. And I think healthcare now gets more affordable, and that will drive consumption of medical equipment and devices because they become more and more affordable. Healthcare costs will definitely go down. So that's a huge impact. And of course, it will be very hard to say what will be the real impact in the current financial year. But I think we still, stay with the guidance of 30% for domestic market growth this year. Export markets, again, little choppy, but still, between 5 to 10%.
Is Chinese dumping a problem here in India?
It is a major problem. It's a major problem.
Okay. How big a problem?
I think, wherever we have seen PLI being offered in India, I think Chinese have been dumping the product in every sector. And I think I was talking to some of senior government officials, and they've probably mapped it that out of the 14, 15 sectors where we have PLI, Chinese have actually, dumped prices in around 12 to 13 sectors.
Wow.
That's a big issue right now, I think.
Wow. So I mean, your products are having to compete with the products here from China. Obviously, price points there are much lower.
Yeah, they are lower, and I think, we have given an easy entry to Chinese products in India. Whereas, when we want to sell in China, it would take 3 to 4 years to register a product. Whereas in India, it's much easier for them to register products and sell in India. So, and also they don't have, transfer pricing issue. They don't take care of anything. So all that actually, push manufacturing back in India to a certain extent. But I think it's a matter of time where I think we will get out of this, and I think we'll become more resilient.
Okay. Hope so. I mean, maybe the government has to do something. Maybe the industry with scale becomes more competitive. I mean, it has to be a mix.
There is a lot happening at the government level also. You've seen GST reforms and other stuff. So I think we are very positive on this.
Absolutely, sir. It's an industry where I think why shouldn't Indian companies like you have more share and reduce import dependency in a big way. Thank you very much, and good luck to you as you execute. Appreciate it.